Welcome to our double top tutorial. Right, what you want to do is pull up a seat, crack open a beer, get a pen and paper and write this shit down because you need to know this if you want to trade. Right, here we have the weekly chart for the S&P 500. The S&P 500 is a list of 500 stocks. If you add all their share prices together, it gives you the total of the S&P. Um, as of 1995, we started quite a good bull run on the S&P 500. Um, it pretty much makes higher highs until it gets to a certain point just here, and that is the highest high it put in. That was the top of that bull run. It backed off. If you made a higher high, you've got nothing to worry about, but it didn't. So that we marked down as a very strong resistance point. This what happened then. This is basically what a stock market crash looks like. When you hear it on the news, stock market crashes, this is what happens. As you can see from the top to the bottom of that crash, the stock market lost about half of its value, which is a lot on an indice. This was around the time of the millennium, and the reason for the stock market crash was the dot-com bubble. I'd advise you Google that because that's quite interesting. All the technology companies just shot up and then the bubble burst. It went on a bit of a bull run, and then we get to this point here where we can actually mark a potential double top. This is something the traders would have been looking at the time. You can actually see here, we've got, if we zoom in, we've got two little double tops here. We've got a double top within a double top. You see, I'm just going to circle it now. It has a go at resistance, that red line. It backs away and then has another go. That is just throwing it in your face. Look at me, I'm a double top, sell me. That's what it's saying, and look what happened afterwards. This is the biggest crash of our lifetimes after that double top. This isn't nice to say, but it's the truth. There would have been a lot of suicides over that crash. There would have been a lot of people putting in a lot of money, investing a lot of money, and because they don't know what we know, how to read charts, they wouldn't have seen it coming. The stock market on that occasion lost over half of its value, which is just huge. That was around 2007, 2008, around the time Lehman Brothers went under. The banks needed bailing out. It was pretty much financially the end of the world, and look how quickly that happened. People would have been wiped out over that, and all they needed to do was look at the charts. It was a double top. You could have sold it right at the top. But some people, traders, would have seen this. Traders would have been short, and they would have been making the money that everyone else is losing because they didn't see it. If you would have bought at the bottom, it had a little run. You see how slowly the stock market builds after how quickly it crashed. There's something interesting pops up here. We are heading for that line again. That's that long-term resistance line. We're heading for it again. I would say in a couple of months we're going to hit that, and we could have a triple top on our hands. Now, if you want to know what is likely to happen from this, we've got a tutorial in our members section of the website, wemakemints.com. Log on and you'll see what's likely to happen. Some books will tell you, and maybe some websites will tell you how to trade a triple top, but it has changed over the years. We've found this, it has changed over the years. So come on and we'll show you that. I'm just pointing out here, there was a potential double top, and you could have traded it as a double top at the time, but it made a higher high, and that is the key. We want to sell a resistance point where it does not get above. We've got another example of a double top, this time on crude oil, the chart for crude oil. It came up in a very bullish channel, hit a certain point, and it actually was such a strong resistance that it actually broke through the channel. So at that point there, what you want to do is draw a red line across, and if the market ever comes up high enough to meet that again, that red line, you should consider it as a double top and trade it accordingly, in which case that's exactly what people did. The market came up, had another go at that red line, and just sold it. It fell. As soon as it hit that, it fell. It could have got above, but it drifted outside the channel for a little bit too long, and I think that's why people thought, no, we're not going to be buyers here, we're going to be sellers. And then we got the big down candle on the last day of this chart. So this is a double top. It's not as obvious as the S&P example, but it's a double top nonetheless, and that's why, as I say, we had the big down candle on the right hand side. Um, so we had a strong uptrend, um, making new highs. We hit that resistance line. Now, at that point, you don't know what's going to happen tomorrow. Um, it got underneath that support line. What actually happened the next day? This is why I don't always sell one close below support, because it could have the next day come back up and made a higher high, but it didn't. It tested that green line. As soon as it backed away, sellers would have flooded the market and been like, right, okay, we're going to take over here because it's not going any higher. And that's why you had the down move after the support. We've got a little example of another double top that actually failed. In a bull market, you will get resistances. The price will move up to that resistance point, have another go, and it will smash through. As you can see here, we've found resistance. We drew our red line across. The market backed away, so we drew our red line across. And then at the second time of asking, it just smashed through that resistance point. It's quite interesting here because once you break a resistance, it becomes a support. And what actually happened is the next few days, the market was a little bit uncertain. It needed to test that red line again and again and again. And then it had the confidence to say, right, okay, the buyers are coming in, the market's going higher. And then it just went on a nice bull rally. Right, one more example for you thickos sitting at the back of the class, not paying attention. Coal of Africa had a good bull run, hit around 23.5 pence, and it backed away. So what we would do is we found a point where the market goes up to and backs away. We draw a red line. Next time it hits it, which it did here, we consider it as a double top. It's not guaranteed, but it actually did. It broke down to 18.5 pence. So you would have made 20% on that trade. Which is exactly pretty much what a lot of traders would have done. Highlighted in green here, a bull flag. So it should have projected over 30 pence, but it did conform to that double top. So we've had a double top in this market, so that should be quite a strong reversal. I would imagine Coal of Africa to break down now. The historic price has been in a downtrend. It had a chance to reverse that. It's coming down and then it goes up, hits that point and backs away. So we know it's a resistance point, and then we sell it as a double top the next time it touches the line.